So hi everyone, welcome to today's accounting design project. It's our great honor to have Richard Sloan to talk about intangible assets specificity. And Richard, you have 60 minutes.
Great. Well, thanks, Ayung. Thanks very much for setting up this series and also for inviting me to present in it and I guess close out the series for this semester, right? This is a paper that is co-authored with Carmen Payne-Mann, who's a PhD student, graduating tomorrow, actually, and then will be moving to work at the University of Colorado starting this summer. And I hope she's on there somewhere in case I run into any questions about the data I can't answer. Um, so this paper's on asset specificity. As I go through it, I should just mention if you feel free to raise a hand or chime in if you have specific questions. I think I've got quite a lot to go through, so I might have to speed things up if we get a lot of questions. But certainly, if questions come up along the way, feel free to chime in. So this asset specificity, it's actually, I'm sure many of you are familiar with it, but it's studied like widely in economics. There's important economic theories surrounding asset specificity. And it's the extent to which an asset's value is tied to a specific use or user. So at one extreme, you'd think about cash as having very low specificity, right? If you have some cash and give it to someone else, it's worth as much as them as it is to you. But then on the other extreme, some assets are highly specific. One example, like a textbook type example, would be an oil pipeline, right? You're transporting oil from a port to a oil well, something like that. And if you run out of oil or you don't make money pumping oil, there's not much else you can do with it. It's not much more than salvage value because you can't really pick it up and take it somewhere else. And there's a number of theories on this in economics relating it to organizational structure. A lot of the pioneering work was done by Oliver Williamson and sort of like hold up costs and transaction costs if you have different companies in a supply chain with specific assets. And so vertical integration is often the solution there. Then investment decision making. Um, some of you may be familiar with the Bergstaller and Ditchev's work on adaptation value, and they study this in economics. And what the theory shows there is if you've got highly specific investments, but a lot of uncertainty about the success of those investments, sort of the net present value is lower because if you end up in the failed state, then you can't, redeploy the assets and reverse the investment. And then in financial policy, as collateral for debt, highly specific assets are less effective as collateral because there is less value to the creditors if they take them. And so debt financing in the capital structure is less suitable. And to test these theories, they have a lot of difficulty because it's just very difficult to measure asset specificity, and it's thought to vary by asset class and also by industry, even by asset class. Now, where intangibles come into this is, first, I'm sure everyone's aware of the fact that intangibles is sort of like a growing asset class today. And traditionally, economists have thought of them as having very high specificity. And so concerns are raised as we move from a sort of physical to more of a technology online economy. We make more investments in intangibles, and these issues that we've discussed above for organizational structure, investment decision making, and financial policy, they all become sort of much more important. And that takes us to the paper that got us interested in this, the Kamani and Ma paper. This is published in QJE, the economics journal, in 2023, and they had a surprising result. What they do in this paper is they build a new data set where they directly measure liquidation values for the main asset categories across major financial industries. And the way that they do this is by taking advantage of these liquidation analyses that are provided in Chapter 11 disclosure statements. So Chapter 11 is when you're bankrupt and you want to reorganize and continue as a going concern. And one of the reports you have to put in there as part of this process is, in fairness to the sort of smaller creditors, you have to show that by continuing as a going concern, you're worth at least as much as if you liquidated. Okay, so they do this liquidation analysis to figure out how much they'd be worth if they liquidated and can compare that to the going concern value. And I've got an example. This is the one that they used in their paper of what these look like. And typically it'll have the balance sheet. I'm just going to move your faces on top of the numbers I'm trying to look at here. Um, you can see that in this company, it's Lyondell Chemical Company, if you're interested, and they say that the cash is on the balance sheet at 238. It's expected liquidation value is 238, and that's both the low and the high and the midpoint, and so you get 100% recovery. Let's see. Well, when we get down to intangible assets, which you can see down there, you can see this has a net book value of 1.2. I'm not forget the units. It's probably 1.2 billion. And a recovery low, mid, and high of 427.6. So you'd say 34.1% is your recovery rate here. And actually, they'd say that's a pretty good recovery rate. It's about the same as the average for PP&E. And so that's the way that they're collecting the data here. Now, me and Carmen initially were interested in using, they make their database public and using it to sort of, our initial idea was to redo like a Bergstahler Ditchev type analysis, but use this sort of more granular data to get a better idea of the liquidation recovery rates, the adaptation value, if you like. But we got sort of like tied up on their results for intangibles. And I should emphasize they have a number of important results in the paper, some really interesting results relating to PP&E and tests of asset specificity as they relate to PP&E, which they can do with their data. But one of the results they emphasize is this result for intangibles, which is obviously of interest given the rise of investment in intangibles. And that's that the average liquidation rates, recovery rates for intangibles, they got 32%, similar to PP&E at 35%. And then they do some analysis in their paper, sort of what if analysis, and they say, okay, we know companies have shifted from PP&E towards intangibles. Let's take our recovery rates, apply them to all companies on CompuStat across the different industries and across time, and see how their liquidation values have trended. A lot of people sort of conventionally thought the liquidation values would have gone down as they shifted from investments in PP&E to investments in intangibles. But what they showed is they've stayed about the same. Not surprising, given that they're finding the intangible recovery rates are similar to PP&E. Okay. And I'll show you what got us interested in this. We found that result sort of surprising. And here's some descriptive statistics you'll find in our paper. You won't find this in their paper. They report some descriptive statistics, but it's all done after first averaging at the industry level, which sort of like makes it a little harder to see what we're trying to see here. Now, what we've got is the liquidation recovery rates by asset class here, averaging across all firms in their sample. They had about, you can see about 400 of these liquidation analyses. And for cash, not surprisingly, it's 100%. For receivables, you can see it's about 64. And look at the interquartile range goes from about 50 to 82. Maxes out at 100. Sort of similar thing for inventory. And then PP&E, it's a bit lower, and it goes from a low of 14 up to a high of 49 at the P75. There's even one there of 122. We looked into that one. We were sort of curious. This was a company that wrote down its oil and gas reserves when oil prices plummeted. And by the time it did its Chapter 11, oil prices had gone back up. So it had written down that asset, then it went back up. So that was what happened. But look at intangibles. The lower quartile, 0. The mean's up at 26 or 33, depending on whether you include the goodwill. Let's focus on the non-goodwill at 33. But over a quarter of them are 0. The median is much lower than the mean, and even the median is only about the same as the mean. And then there's some huge positive outliers. Okay, 799%. So at this point, we're thinking, okay, well, they could be capturing legitimate variation. It could just be a very strange distribution, or something else could be going on here. It could be some accounting explanation for this. Ayung?
Richard, so I'm looking at your appendix 1. It's like those extreme large value. It's because a lot of those intangibles previously was not on the Chapter 11 firm's balance sheet, right?
Right.
Internally developed R&D, customer base databases, relationships. So Are you proposing that they should use some sort of a nonlinear conditional models to actually sort out on the balance sheet versus off balance sheet component of the intangible assets? And then the second stage will be what will be the recovery rate once we have a comprehensive coverage of intangible
Whoops.
assets?
Yeah, well, what we're going to propose, I'll show you the problem with a specific example, and then we'll show you what we propose. This is just a bar chart of the numbers that we've just seen, showing the very different distributions for the recovery rates, with most of them being zero for intangibles, but then the average is being much higher because of a few extreme outliers. So let me show you one more test, then I'll get to Ayung's. So this other test that they did was sort of cool. They did it for PP&E in their paper. What they do is, like, let's say we've got 6 firms in an industry. They're going to get the recovery rates for each of those 6 firms and then average them to get an industry recovery rate. So what they do is they say, to sort of show how well this works, let's treat each firm individually as a holdout and then compute the average for the other 5 firms and see how well it explains the recovery rate that we actually realize on the 6th firm. So they're regressing each firm held out on the recovery rate from all the other firms. When they do that for PP&E, they find a strong positive relation between the average recovery rate in the other firms in the industry and the particular firm they held out. And once you get up to at least 5 firms in the industry, more firms, the cleaner the estimate. By this point, your R squared to 10%, and you're getting, not far off of 1.7 about for your coefficient. And so it seems they're capturing sort of meaningful variation in PP&E recovery rates across industry. But when we did that for the intangibles, we saw those numbers that were varying widely. It didn't work at all. The R squareds were pretty much zero, and the coefficients just bounced around between positive and negative. So it seems like these extreme numbers aren't really capturing meaningful variation across industries. So now, well, hopefully we've presented this paper to economists and law scholars, and this is where we explain the accounting. But I think everyone here is familiar with the accounting for our intangibles. The important accounting rule being we don't capitalize internally generated intangibles, things like R&D and marketing, even when we expect them to generate revenue streams over multiple future periods and future benefits. We do, however, capitalize purchased intangibles subject to these periodic impairment tests. And then, depending on whether they're judged to have a finite or an indefinite life, we amortize them if they have a finite life, and we subject to them to a impairment test if they have an indefinite life. And then, of course, goodwill is sort of like the residual, and these days that's subject to a fair value-based impairment test. Something that I probably won't get into, but affects the trends in the data we use over our sample period. Right at the beginning of the sample period was that shift to 142, SFAS 142, where they eliminated pooling of interest. And so there were acquisitions before that point where you wouldn't get any purchased intangibles put on the books. But since that point, without the pooling option, we've had to follow the purchase accounting for intangibles. And here's another picture I just put up for the economists and legal scholars. I thought I'd leave it in there for you to see. This is 2 companies' balance sheets. NVIDIA, the sort of like leader in AI chips, and AMD, Advanced Micro Devices, which is sort of one trying to play catch up, one of the competitors. One of them has enormous intangible assets, and one of them has hardly any. And when I asked it like economists or legal scholars, I'm trying to trick them, right? And get them to say, oh, it must be NVIDIA with all the intangible assets. But of course, it's AMD, and NVIDIA has hardly any intangibles. And the reason is AMD did a huge acquisition recently of Xilinx, which sort of tripled its assets, and most of the assets it added onto its books. This, tens of billions dollar acquisition of Xilinx was intangibles. And you can see here they were split, about 50-50 between identifiable and goodwill. Okay, so this is, I think, the punchline slide that's going to answer Ayung's question, where it should click for everyone in accounting here. This is American Airlines, just one example where we're going to focus on the recovery rates that were used for their intangibles. And you can see that there's 2 line items for intangibles here. One is their route slots and gates, which had a net book value of 868 million and a liquidation value. They use the orderly one of 3.6 billion for a 421% recovery. So I'm showing you this one because it's one of the high recovery rates. And then they also have another line item down here, intangible assets, there's some other intangible assets where they weren't on the books because they were generated internally. And they had about 170 million. That was mostly customer lists and American Airlines name and a couple of other things like that. Now, why was this one so high? Well, this is 2012, okay? And it turns out that American hadn't done an acquisition since 2001. And when it did that last acquisition, it was Trans World Airlines, TWA. Some of you may remember that airline. And it was a much smaller airline when they bought it. When I judged it, it was about 20% of the size. And, some of the identifiable intangibles with finite lives that they acquired back then, they've been amortizing. They were bigger when they put them on the books in 2001, but they've been amortizing them. Now, of course, this whole time, American's been investing in its own route slots and gates. And what here you've got is or over here is the estimated value of the whole system-wide route slots and gates for American. But what you've got on the denominator is only the amortized remaining cost of the acquisitions that it did many, many years ago, which were just a small part of its total business. So it's an apples to oranges comparison here, and this rate's massively overstated, where we would think because they've missed out all the internal investments they've made to develop their own route slots and gates. Now, what the Kamani and Ma would pick up for American is just this 421. Down here, this one they don't really know what to do with, right? Because there is no book value, so you can't compute a recovery rate. Now, of course, American has invested in its customer lists and things of that nature, but they're not allowed to capitalize it for accounting purposes, and so there is no book value, and so they just leave that out of their sample. I'll show you another case here, Frontier. This one, they hadn't done any acquisitions, so they had some intangible assets, and their route slots and gates are included in that intangible assets category. But since they didn't acquire any other companies, they weren't allowed to put them on the balance sheet, and they have an estimated recovery value. And so this one got left out of the analysis because, again, it's not meaningful. And then the last one I'm going to show you, or second last, is Mesa Airlines. This one, we just want to show you, we had to decide what to do in a case like this. It hadn't done any acquisitions, so there are no intangibles on the books, and it didn't show any recoveries for route slots and gates. So we assume in this case, whoever did the liquidation analysis must have assessed that their route slots and gates had insignificant or zero recovery value, even though they must have, over their life, made internal investments to develop their route slots and gates before they went into bankruptcy. Just to show you how crazy this can get, I'll show you one example we came across. Now, Kamani and Ma, this was in their sort of sample of liquidation analyses, but they didn't actually include this rate. You'll see why in their actual empirical analysis. So we found this one company, Forland Corporation, which had a geophysical database, that was its intangible asset, which had a liquidation value of $50,000, but they had it on their books for $1. And so when you recruit the recovery rate, remember the highest they had in their sample was 799. If they'd included this one, they would have had 5 million% recovery rate. And we actually went and looked at Forland's 10K, and we couldn't find this $1. We suspect, though we don't know for sure, that whoever did the liquidation analysis just thought, oh, I'll just put $1 there to put something there, like a token amount. They weren't ever thinking that someone would come along and try and compute a recovery rate from it. But I think this really highlights the problem of the apples to oranges, that the recovery of all the intangibles versus the book value of only the purchased intangibles. Now, there's a second part to this that for some of you, if it wasn't clear to me, if you're mathematically minded, you'll see this straight away. What they're going to do is take their recovery rates and they're going to apply them to all the firms on CompuStat. Now, what many of you, I think, are going to be saying now is like, yeah, I understand their recovery rates are too high because they didn't put all the internal stuff in the denominator. But when they apply those recovery rates to firms on CompuStat, They're going to only apply it to the purchased intangibles that are on the books. So they're applying a too high rate, but they're applying it to too small of an asset base. And so maybe it'll all come out in the wash. Now, unfortunately, that's not the case. And it's due to something you may remember from your PhD days, Jensen's inequality. And I'm just going to show you a simple example here so that you can see it. Let's assume we've got three firms in an industry. They've all got, let me just move this because I can't see my own, off-book intangibles of 100. But firm A has done very few acquisitions and has only 20 of purchased intangibles. Firm B is about 50-50, and firm C's done lots of acquisitions like AMD, so that's 180 of book intangibles, more than its off-book. Let's assume that the actual recovery rate is 10%. Then we come along and do the Kamani-Amar procedure and estimate the recovery rates. So here you're going to get a $12 recovery rate, 10% of 120. And they'll come and say, oh, like we got a recovery of 12, but we've only got book intangibles of 20. That's a 60% recovery rate. Then when they come over to this firm here, they'll say, okay, the recovery was 20, 10% of 200, but they'll take the 20 and divide it only by the 100 and come up with 20%. And then for this firm here, it's 10% of 280 or 28, and they'll take the 28, divide it by the 180 and come up with 15.6%. Now, what you can see here is that when the two are the same, you just double the rate. But for the firm with few acquisitions, even though it's 80 less and 80 more, so it's symmetrical up here, this recovery rate shoots up to 60, whereas down here it goes down to only 15.6. And this is Jensen's inequality at work. So the average rate is not 20, it's 31.9. Okay. And when you come and apply that industry average to all of the firms in that industry, you get a low recovery here, but up here, you're applying a very high recovery rate to a firm with very high book assets, and you're way overestimating the recovery relative to what it actually got. Okay, so I'll just say, if you want to know that mathematically, I wrote it down so I'd remember. In Jensen's inequality, it's the expectation of the ratio of two random variables that are strictly positive is strictly greater than the ratio of the expected value of the random variables. Okay, but what this all means for them is when they take their rates and apply them on firms on CompuStat, they're going to overstate the actual recoveries that you'll get, just as we sort of did in the average here and the numbers here. Okay, so what we're going to do, I'm just going to move this faces again so I can see. What we're going to do, I'm sure many of you are familiar with this. We did it because it's the most widely used and the numbers are available on CompuStat, so we thought it would be the least controversial. But what we're going to do is redo the recovery rates after incorporating estimates of the off-balance sheet intangibles, so we can do an apples-to-apples ratio. Okay, and we're going to follow the procedure in Peters and Taylor, a JFE paper in 2017. And one of the convenient things about Peters and Taylor is they make their estimates available on words. So we just have to take their numbers off of words. And what they do is they use the perpetual inventory method for investments or expenditures on intangibles, where I is the stock of the intangible capital that's off the balance sheet. Whoops. Delta is the amortization or depreciation rate. And E is the periodic expenditure or investment on that intangible, like the R&D expenditure, for example. And they do this for two types of intangible capital that they sum together. The first they call knowledge capital, and this is based on capitalizing 100% of the R&D expense. And for most companies, they depreciate it or amortize it over at a 15% rate. And then the other one's called organizational capital, where they do 30% of SG&A expense, trying to pick up things like marketing and investing in corporate infrastructure or corporate, strategy and the like. And they use a 20% amortization rate for this one. Now, I should point out there's another approach that's used in finance by Eisfeld and another co-author that's popularized using 100% of SG&A expense. So this is viewed to be somewhat conservative. And what we actually found out when we were looking through companies on this, I'll show you this in a second, for utilities, they don't have any SG&A expense or any R&D expense typically on CompuStat, but they do investments in intangibles, things like emissions allowances and things of that nature. Uh, so this isn't a perfect solution, but we're going to run with this for now. And
Okay.
just to Ion,
Can I ask you, can I give a comment? So I think Peterson, Ryan Peter has a new paper published in the Medicine Science using the purchase price allocations, try to kind of calibrate that 30%, 50% to be a little bit more sophisticated. Would you consider using that? That's kind of
yeah,
like
yeah, we
estimate.
would. My recollection of that paper is that they
Yeah.
found these rates to be about right, right? I'm trying to think. It wasn't like they were way off or something. I think that we'd certainly consider using it. My recollection is that they were sort of
Like
similar.
confirming it.
Yeah. Um, what what we have, well, let me get to where we have an issue with this. Um, so what I'm just going to show you here is when we took that 421% recovery rate for American that they used, and then we added in the off-balance sheet intangibles, it went down to 83%. Now, for the other airlines, it went down substantially. And for that foreland, remember where they had the 5 million%? Once we included the off-balance sheet intangibles, it went down to only 3% because they'd had that odd thing where they'd had just a $1 of book value. This still puzzled us here. We thought, look, it's gone down a lot, but 83% seems sort of high. So we went in to look at this. And the thing is, if you look at American Airlines income statement, there is no line says SG&A or anything like it. And in fact, prior to 2003, CompuStat put all of American Airlines operating costs in cost of goods sold. And then it started putting about like 10% or so of them in SG&A. I couldn't work out exactly where it got them from because there was nothing that sounded like SG&A on the income statement. But what became clear to us is a lot of the investments you'd make in trying to, build your route slots and gates, like assembled workforce and stuff like that, are going to go through cost of goods sold. They're not going to go through what CompuStat classifies as SG&A. So we actually think that, even our revised rates are too high. And so nevertheless, once we do this across the board, here are their original rates. This is sort of like our headline result on how the rates change. So they had 24 for intangibles, 32% for non-goodwill intangibles. Once we make our adjustments, which we make down here and incorporate the off-balance sheet intangibles in the denominator, it goes down by an order of magnitude to only about 2.85% or 3.79%. Very different, right? Suddenly they don't look so, they're only about 1/10 the size of PP&E. There was some sample differences, so we showed this rate down here just to show it wasn't the different sample sizes that were driving it. It was the adjustments that we made to the denominator. The medians are even lower over here. Bottom line, what we'll see later on, recoveries on intangibles are sort of negligible. It's hardly even worth trying to model them. They're so small. Here's just one example in a bar chart of an industry, like take consumer durables. They said for PP&E, you get a 31% recovery, but for intangibles, book intangibles as a whole, 52%, non-goodwill intangibles, 68%. After we make our adjustments, it goes down to only 2% and 4%. A big difference. Now, what we noticed here was, can you see how utilities, it sort of looks still the same, pretty high? And telecom, it looks pretty high. And others, which includes the airline stocks down here, still look sort of high. They're all like above about 5%, where all the others went real low. We did some investigation because we were concerned about that. And we found out, many of you may know this, for utilities, CompuStat has a stated policy of putting all their operating expenses in cost of goods sold, and none of them in SG&A. And so what we found here was for nearly 100% of utilities, they don't have any SG&A. It's missing or zero. And we found similar for telecom, and we actually found a similar issue for, well, you can see for healthcare, and then in others, the airlines was part of that, what was driving that. And in utilities, when we look at these utilities acquisitions, they have these emissions allowances that can be pretty sizable. But what we want to emphasize is the company has to invest in building those intangible assets, but it doesn't go through SG&A and R&D. It goes through cost of goods sold, and it gets missed from our analysis. Question, Waka?
I'm just curious, Richard, about so we've got the by nature and by function option in the income statement. Is it because so many airlines internationally they report by nature, so they've got the expenses which do not follow the bifurcation of
Right.
cost of sales versus below the line SG&A. So do you think because it is these missing values or the lack of data is because of this, which can be circumvented to further investigate what you're looking at?
Yeah, it's just and they're service companies, right? So instead of reporting, they don't really have a cost of goods sold. They have labor costs, which they report in one line item, and they have fuel costs, which is their biggest cost. And then they had a other thing down at the bottom, which the only place I could see anything like R&D or SG&A would have been in this other operating expenses line item. It's just that the nature of the business doesn't really lend itself to the sort of manufacturing style or retail style template that CompuStat uses. Yeah. Sudipta?
So it strikes me that what's common to utilities and telecommunications and maybe even airlines is that there's a lot of rate regulation.
Yeah.
And so there may be an incentive to reduce your gross profit so you can ask for higher rates. So it may be an artifact of the regulation rather
Right.
than
Yeah.
in
Yeah.
CompuStat reporting. It's the airlines have this incentive
Yeah.
to report lower gross profits for the rate
Yeah.
or the
Yeah. And what I would
telecom.
say is, with them, you inherently have to talk about an operating profit margin. A gross profit margin is hard to define because they don't have a cost of goods sold, but their
But if they're
operating
reporting everything as
profits.
cost of goods sold, then that's the gross profit.
Exactly. Yeah.
Right?
Yeah.
So, I mean, it's
Yeah.
operating profit, but reported as gross profit.
Exactly. Yeah.
And that may be because of the way that the rate regulation works.
Yeah.
There's production costs that are being
Yeah.
reimbursed or
One thing you've reminded me of too, one question we frequently get that K&M would have, Kamani and Ma would have got, is that, you know, what are the incentives of companies and stuff when they're getting these liquidation analyses done? Because they probably want to do Chapter 11, so they probably don't want the recoveries to be too high in liquidation. But then they're getting experts to attest to them and stuff. So there are issues running around there with the incentives of the managers too. Okay, the bottom line here is we don't actually think our recovery rates solve the problem. And in some industries, they're really bad. And we excluded some of those industries from some of our subsequent analyses just because we acknowledge that we're not solving much of the problem either ourselves. Okay, so you can see the recovery rates are a lot lower. What we now want to do is take those lower recovery rates and apply them to the time series analysis on CompuStat that Kamani and Ma did to see if it changes their assumption that the increasing investment in intangibles hadn't changed liquidation values. And what I'm just showing you here over the sample period that they looked at, over here you can see intangibles have gone up. Mostly this is driven by the book intangibles. And here's when the new standard came in, and we think part of this is the elimination of pooling of interests. And at the same time, PP&E, which is this gray line up here, has been going down. Most of the others have been about the same, right? I think cash was going up a little bit too. Cash holdings up, PP&E down, and intangibles going up. And there's some people in finance, some scholars in finance argue that the reason that cash has been going up is because intangibles has been going up, and that increases this like investment problem of if your investment fails, you can't like get your money back, so you hold more cash to buffer yourself against that. Okay, so here's what they do, right? Just so everyone's familiar. They've now got their recovery rates from their bankruptcy sample by industry. They're going to apply those recovery rates by industry to every firm on CompuStat. And so they'll take, the cash recovery rate, the PP&E, the inventory receivable, and they'll go to their balance sheet, see what the balance is, and apply that recovery rate to that balance and estimate how much they'll recover. Then they'll divide that recovery by the total book assets and come up with the estimated recovery rate, and then they'll see how that trends on average over time. The idea is to see, well, as PP&E's been going up and PP&E's been going down and intangibles going up, has the overall recovery rates for the firm been going down? We're going to replicate their approach, but with two changes. First, we're going to use our adjusted recovery rates for intangibles. They're a lot lower, but we think they're, more appropriate for what they actually recover. And then we're going to deflate not by book assets, but by the sum of book assets and the Peters and Taylor off-balance sheet assets, which represent the full amounts they've invested. And then we also do some tests where we've like, look, even our off-book assets that we've come up, we think are too low. We talked about some that we missed out for airlines. So we're also going to try and deflate by the market value of equity. So what are the recoveries as a percent of the growing concern value as based on the market value of the firm, and see how they trend over time. This is what Kamani and Ma found. These are the average recovery rates at the firm level, summing up across the different categories. And so you can see this blue dotted one here is PP&E, which has gone down over time because PP&E balances have gone down. But then the gray one down the bottom is book intangibles, and that's been going up because intangibles have been going up. The other one that you can see here is the cash has been going up because companies are holding more cash balances. And, they'd sort of say, overall, these numbers sort of have been pretty constant. So the increasing prevalence of intangibles doesn't seem to have had a big impact on liquidation recovery values, which is what some other economists were worried about. Well, when we redo our analysis with our rates and deflator, we see, in fact, they have been going down. They've been going down overall. They've been particularly going down in the red parentheses here once you ignore the cash holdings, 28, 21, 19. And that's because PP&E's been going down and intangibles hasn't been keeping up because the recoveries are actually a lot lower on intangibles for us. And we view these increases in cash as potentially just a response, as predicted by economic theory, to the more difficult, the increased difficulty of reversing investments in intangibles, and hence holding a larger cash buffer in case you don't get your anticipated return. And, there's some discussion of that going on right now, right, with these huge investments in IT and AI. Once we deflate by market value, these patterns become even more pronounced, and you see these sort of pronounced declines. This is our revised rates, and deflating by market value, you sort of see a very different pattern. So we sort of think the idea that the shift to investments in intangibles haven't reduced liquidation values significantly is premature. And using our revised rates and adjusting the deflator, we actually see significant declines.
So what about the cash held overseas and not being repatriated back because of, the different tax and stuff? How much is that?
That could play a role in the increased cash holdings because that's going to show there if they consolidate them right. What I'd say, what I think, and I do think they tried to, in the first Trump administration, I forgot what it was called, the act, forgotten even the acronym now. But they did try and solve some of that problem to get some of it to be repatriated. But this could be an explanation. Yeah, there is a paper. I remember the name. I think it's Pilato was the lead author. We cite it in the paper. If you're interested to take a look at the Filato, Kidras, Hadvova, and Simon Steri. And that was the one where they sort of claimed that one of the reasons for the increase in cash was this increase in intangibles. Okay, so
I have a quick question.
sure.
Yeah, I was just wonder if you can fit profitability analysis into what you're doing. In other words, the recovery rate should depend upon the track record of profitability. But so far, you haven't mentioned anything about the track record of profitability. And maybe I'm missing something, so I don't want to interrupt you.
No, that's okay. And I'm trying to understand, what they would argue here is that it's the recovery when you want to take the assets and put them in an alternative use. So, your past profitability, by definition would be not relevant in that
I don't
setup.
think that follows, but it's fair enough.
Yeah.
All I'm saying is that when we're looking at something like recoverability or whatever have you, we would ask what does the track record of the firm show? If you have a very well-run firm or whatever have you in a good business, you will show high profitability and high recoverability. But this may be my naivete. So I was just wondering if you simply dismiss the track record of profitability.
No, it's a really good question, and there's a big literature in economics and finance now,
And
sort of,
FSA.
yeah, pushing back on this idea that, you don't lend on intangible assets because they have low collateral value. And it's sort of like arguing that you lend, on the
Track
profitability and the
record.
ongoing cash flows
Yeah,
yeah,
correct.
that it's not that simple to just sort of like dismiss that part of the calculus and go straight to liquidation value and trying to apply them to, the assets to a different use. So everyone see what they're thinking about here is like, you take a delivery truck and you think, well, if I'm doing widgets and no one wants widgets anymore, but there's some other product that people want, I just sell my delivery truck to whoever's producing the other product, and it doesn't really matter. With IT, it's harder to do that, but but what you can lend against is the ongoing cash generating ability of the operations itself,
And
rather
thank
than
you.
what
Yeah.
you think they'd be worth if the company went broke.
Again, what you could do, and then I'm going to keep quiet, is to look at accounts receivable as a benchmark. So once you have a benchmark that goes slightly beyond cash, then the question is that a leading indicator what we expect to see in general?
Right.
In
Yeah.
other words, right now you're juggling and you're adjusting, and it becomes sort of a little bit unwieldy, and you're juggling quite a few balls. So it's very hard to see how we're going to ultimately, quote, recover knowledge from a total and getting a total punchline.
Yeah. Yeah. Yeah.
Okay, sorry,
It's
yeah.
no, it's a very good point. And it's almost like above our pay grade in this paper. Like I said, there's a lot of papers exploring that right now in um in the economics literature, and how do you even think about you can't, you have to move past this simple bifurcation into the existing company continuing to do exactly what it's doing versus it liquidating and the assets going and doing something completely different. The last part of the paper, we've got some new analysis that I want to share with you, and there's a slide that I missed out that I'm going to describe. I wasn't sure if I'd had time to do it, but I'll give you a quick overview. I think it's table 6 in the paper. But I mentioned that, we thought even our adjusted rates, while they move in the right direction, we haven't perfectly adjusted for investments in off-balance sheet intangibles. And, as I was mentioning Ayung earlier on, like one of the implications of our paper, I would hope, is that it's very difficult for us as outside the company to understand exactly what investments a company making are in intangibles or their investments they expect to generate economic benefits in the future, and exactly what the economic life of those investments is. Without the company helping us along, I don't think investors or researchers are going to be able to do that just by doing the sort of simple algorithms that we're doing here. But what we found is some serious problems even with our adjusted rates. So we did some analysis in that hold one out type procedure that they did earlier on to see sort of how well our adjusted rates versus their rates predicted recovery values across the whole firm. And what we found is that the Kamani and Ma's industry level rates did pretty badly, and our industry rates did somewhat better. But one interesting result we've said there is said, well, let's scrap doing the industry rates altogether and just take the whole sample-wide average from that liquidation sample and just use the average rate across the whole sample and apply that to every firm. That actually worked much better for Kamani and Ma because they got rid of all the industry, noise. And actually, it was about the same for us. So that led us to believe, if you believe this analysis, our industry rates really don't have any signal in them. just averaging them across all industries and applying that same rate to every industry did about as well. Okay, so you know, we don't really want to sell people on our adjusted rates. We think they're a step in the right direction, but they're far from perfect. So what was suggested, you know, when we presented this, people said, okay, you've convinced us you've got this sort of twist on the Kamani and Ma result, but can you do anything more with it? Can you sort of push it any further and a sort of like come up with some, you know, significant new conclusions yourself? So what we're going to do, Ayung?
Sorry, I found your earlier discussion about table 6. I have the following question. So does that mean that we potentially do not have a good industry classification system? So the industry doesn't work, potentially is the measurement error that we do not identify industry properly? Or it's simply just, we don't really need an industry, like economic wide
Yeah, what we think's
parameters would be enough. Yeah.
happening, there's probably some underlying variation in the true recovery rates across industry. Okay,
Yeah.
but we've only got a handful of firms in most industries, and there's a lot of error in the way that we, you know, potentially try and estimate the off-balance sheet intangibles. So we just feel that the error is dominating the signal, and so that, you know, like trying to sort of like squeeze some additional information out of these industry rates doesn't really buy you much.
Okay, so it's the
Yeah,
measurement
exactly.
qualities.
Yeah, you know, like a nice thing to be able to say in this paper is like, oh, you know, we've come up with some perfect rates or almost perfect rates, and so now we'll put our database online and people can use that one. But we just felt like that's not the case. It's a tougher problem to solve. So we did get some results that we think are interesting that we just put in this version of the paper. So what we're going to do, if our rates are better, right? When we test the key economic theories of asset specificity, we should find stronger empirical support. So it's sort of like a joint hypothesis here that these economic theories hold, and we've got a cleaner measure of the actual asset specificity at the firm level. And we're going to test 3 of the key hypotheses, just simple tests from the economics literature. One is that, you know, relates to financial policy. One relates to the investment decisions, and one relates to the organizational structure. So in the economics literature, higher recovery rates should imply more borrowing because your assets are better collateral for borrowing, which we proxy by higher leverage or debt to assets. Lower cash reserves because you don't need to save up for a rainy day in case your investments fail, because your investments are not irreversible. You can liquidate them quite easy if you've got high recovery rates. And then you're less likely to vertically integrate. These were the Oliver Williamson's and others' theories that because of hold-up costs and transaction costs of different firms in a supply chain having specific assets, you're more likely to have a vertically integrated ownership structure. And we proxy, this is the proxy from the literature, the vertical integration by gross margin, with the idea that the more of the capital investment across the supply chain you have, the higher your gross margin. And what we're going to do is estimate the recovery rates, the non-cash recovery rates for the firm using the old Kamani and Ma rates versus our rates, and see if we get stronger support using our cleaner rates. So everyone gets the idea here? We're going to go again to all firms on CompuStat, take the rates we computed from the bankruptcy sample, and we're going to toggle the intangible recovery rate that we use and also the deflator that we use. So we're going to use their rates versus our rates. And when we use their analysis, we'll deflate by book assets. And when we do our analysis, we'll deflate by book assets plus the off-balance sheet assets, the investments that had to be expensed for accounting purposes. Now, one thing with what we found out when we did this, I'll give you a preview of what was not clear to us until after the fact. Using a different deflator has a very important impact, because there's some companies like IT companies that actually had pretty high recovery rates when Kamani and Ma did their analysis, but they get shrunk way in when we do our analysis because they have a lot of internally generated intangibles from their R&D. Okay, so there's two factors that cause our results to differ. One is using different recovery rates, but the other one is measuring the recoveries relative to a different asset base. How much did they invest and what are they recovering? And the latter has a big impact. So we're going to do it three ways, the results three ways. First, we're just going to assume there's zero recoveries on intangibles. We just make a blanket assumption of zero. When we do our approach, we're going to deflate by a different deflator because we're going to have book assets plus the off-balance sheet, but we're just going to assume zero here for both cases. Then we're going to use the industry rates, ours versus theirs, and then we'll use the sample-wide rates, ours versus theirs, which I said seemed a little bit less noisy for them in particular. Okay, so this is what we get when we assume zero recoveries on intangibles. For leverage, you have a positive predicted coefficient, for cash negative, and for gross margin negative. And there's some mixed support here. For leverage, it's not supported. The sign's right, but it's not significant. For cash, it is strongly supportive. And for gross margin, it's marginally significant. So there's some sign in support of these basic theories, but the R-squareds are pretty low and the results are mixed, insignificant, significant, and marginally significant. When we use our approach, which remember here, all we're doing is switching a deflator. We're sucking in those industries' recovery rates if they have large investments in off-balance sheet intangibles. Suddenly, we find that all the results receive strong support, even assuming zero recoveries on intangibles, positive for leverage, negative for cash, and negative for gross margin. Next, I'm going to, instead of assuming no zero recovery rates for intangibles, I'm going to use the industry rates. Both sets of results actually get a little bit weaker. Not so much noticeable for ours, but for theirs, the gross margin becomes insignificant because we actually think we're just adding noise by trying to model these industry rates that are very noisy. Okay, and when we use the firm-wide rates, the results look almost identical to panel A because the recoveries on intangibles are pretty small, particularly when you look at our numbers, they're sort of like rounding error of the panel A because the recoveries are so small on the intangibles. Kailash?
Hi, Richard. Very interesting. So I'm a little bit behind because I'm stuck on thinking about Ayung's question on table 6 about why the industry level results don't seem to work that well. And I acknowledge that it's a very small. You don't have to go back, but
yeah, I was just curious. I think I have it here.
Yeah. So I see your point that for the K&M method, going sample wide does a very good job, and for your method, it doesn't really make much of a difference.
Yeah.
But I'm wondering, is that because your capitalization is just using Peters and Taylor? Kind of like Ayung's first question. Maybe if you use the industry-specific depreciation and capitalization parameters, like I know Shiva has a paper that does that with Anoop, and then you could also use the Ewens, Peters, and Wang paper that Ayung mentioned. But maybe trying one of those more updated methods could actually get your industry analysis to be more accurate.
Yeah, that's a good question. Let me show this. I'm glad you mentioned this because I wanted to we actually think we came to the conclusion, we spent a lot of time on this and we thought, like, to be honest, it's sort of like a, quest for the Holy Grail or something. So here are the limitations of our adjusted rates. So the P&T assumptions is one. Using CompuStat data, you tweak the P&T assumptions. But we found that was the tip of the iceberg. Second, we've got this CompuStat classification assumptions for utilities and chemical companies and all the rest of it, where they stick everything in cost of goods sold. How are you going to fix that? Okay, then we've got like a real serious problem with impairments, right? So what do we do in accounting for finite-lived intangibles, or and PP&E in that? We impair them down to fair value. So think about we're estimating these from a sample of bankrupt firms, and we have a graph in the paper showing what do a lot of these firms do as they approach bankruptcy. In this very sample, they do huge impairments, right? Because they're going bankrupt. And a process of those impairments, they mark their assets down to fair value. And then you basically, if for your book value, you're using what they've assessed as the fair value and comparing that against a liquidation rate. And so it'll bias them towards 100%. And then we have this problem over the sample period. Many acquisitions before the start of our sample period, you didn't put any purchased intangibles on the books. For all acquisitions after 2001, you're putting all of them on the books. So you get this growing amount of intangibles that go on the books, which really messes up that time series analysis. And then a final assumption, that I think is heroic in here is that the recovery rates for book and off-book assets are the same. We've got these book assets that are on the books, using GAAP, and these other ones where we've used these Peters and Taylor for, and the book assets came from acquisitions, and these are internally generated, and we're essentially assuming that you can apply the same recovery rate to both of them. So, I just think it would just take so much work to try and claim that you'd really got some good recovery rates that, we decided it was better to just acknowledge there's a lot of issues and we don't have any easy solutions.
But yeah, I think this was very well discussed, and it's very transparent. But I still think that if you're going to make a point on table 6 about the fact that this industry thing isn't working as well as you would have expected it to, it might be worth. I don't think it should be too difficult to take one of these off-the-shelf updated methods. And obviously, it's not going to address most of these issues that you've raised, but it'll address one small thing, and it might be worth running.
Yeah. It's one of those things we can try it. I mean, obviously, if it made a big improvement in the table 6 results, that would be encouraging. If it didn't,
Right.
then it's probably like
You're back to where you are right now.
Yeah, exactly. Yeah, so it'd be good to take a look at. Thanks. Okay, I think I'm pretty much on time here, so I'll just sort of do my summary and conclusions. So we think this is a valuable database, and I do want to remind everyone that the results for PP&E were very strong and supportive of the underlying theory, and they provided some results sort of showing PP&E, the specificity that it varies as a function of things like the mobility of the asset, the degree of customization, and the durability of the asset. And so we're only looking at one of the issues that they raised in their paper, but we think this intangibles one's an important one, as I think they did, simply because that's the way the economy, particularly in the US, is moving. And Ayung had asked me, to talk about, well, what's the implications for accounting design? And since 1972 or whenever SFAS 2 came out, we've been in this sort of mode in accounting where, as accountants, we don't even really try to provide users with information about the expected future benefits from investments in R&D and other intangibles. And, I think we're making life difficult for a lot of external users, and there's a potential opportunity there. There's obviously a lot of challenges for intangibles to it, but it's not clear to me that there aren't challenges for physical assets either. They also have uncertain future cash flows. But they had a couple of conclusions there. And our analysis suggests, that the recovery rates on intangibles are very, very low. They are very highly specific assets, and that the shift towards intangibles has in fact led to a decline in liquidation values, and so a structural shift in the economy. And finally, those final results that we got there, that even though our rates were sort of noisy, simply the act of what we can do a lot more cleanly is deflate the denominator of our recovery rate to include not just investments that are on the books, but investments that are off the books. And we think that that is a good adjustment that gets us a lot closer to economic reality. And when we did that and tested the economic theories, they received much stronger empirical support. So we thought that was one encouraging takeaway from the paper. We were happy to put these results in because we didn't want to end on sort of a note like, hey, they've got a problem, but we don't know how to solve it. We wanted to point out there are some positive implications and some for future research on how to address these issues, even if you're sort of better off just assuming close to a zero recovery rate for intangibles. Okay, so I've got one last slide here that Ayung asked me to share with you. We're happy to sort of wind up the schedule here, but do want to remind you that next fall, in the coming fall, we'll start up again. There's a deadline for submission of September the 8th. And you can contact Ayung by email. And thanks again to Ayung for organizing this again, if you'd like to submit a paper. So with that, I've
Thank
got
you so
a minute or two
much.
for questions, Lisa, if you'd like to.
Oh, super interesting. I actually, maybe I think your ending is consistent with what I thought because throughout your presentation, the only thing I was thinking is actually, if anything, your paper is actually trying to help their paper, Yuran's paper. I remember she presented at Chicago when the first working paper for the intangible part, like what you said, actually. The way is actually doesn't support the economic theory. So the way about asset specificity, so the way they were trying to resort to is actually to use the asset scalability. And then I feel like your paper just trying to say that actually, if anything, everything is consistent with the economic theory. It's just their paper. So my guess that's why for their intangible asset part, they put like they try to de-emphasize because it's not really consistent with the asset specificity theory part. And I think the implication is even broader because I know that Amir Sufi at Chicago, they are also doing the intangible asset in the customer capital. So maybe something your paper can also provide some implication. Just in general, to me, I don't view kind of like the contrast. I feel like everything is consistent. If anything, this paper actually helps their paper.
Yeah. I hope so. And you know what I would hope and what we enjoyed with this paper is being able to talk to audiences across finance and economics, and that we can bring something to the table, hopefully from our knowledge of accounting, but ultimately, help use that to solve broader problems than just, very sort of stylized accounting problems, but to help them interpret the accounting data to give more powerful tests of their economic theories. Yeah.
I think that the primary problem you face is that is it possible at all to get something resembling robust conclusions? In other words, you leave potentially an impression that you get these conclusions or those conclusions, and everything depends upon the specificity in the data analysis. If you change the data analysis and do something similar, reasonable, will you then get the same conclusions? I think in my mind, that's the primary problem.
Yeah. But I think I mean, it's still important for us to try and bring data to address these problems, right? And understand the tensions that are the economic tensions. Yeah.
But
I was
there
I'm looking, Jim. I'm not sure.
as to how you address the problem.
Yeah.
Sorry.
No, I was only going to say I was looking forward to saying hi, but I can hear you, but I can just see a stack of books there. I'm not sure of other people, but I hope you're doing well. It's good to hear you.
My head is long gone.
Yeah.
You see what I'm saying? In other words, let's
I do.
do something very simple and just split the sample period into two samples.
And
then get the same results. In other words, if you make certain conclusions today, and then we visualize 10 years down the line, we're going to replicate what you're doing, are we then going to get the same conclusions?
Yeah.
And I don't think so. That would be my guess. Because the concept of intangible is too loose.
Yeah. Well, I will just say I was encouraged by the fact that, when we looked into the paper and tried to measure the variables in ways that were closer to the underlying economic constructs, the results got stronger. Whether, like how robust they'll be over time, we'll have to wait and see. But I did feel that was encouraging.
That's fair enough, but also lurking in the background is the concept of wishful thinking. In other words, you're looking for certain things, you play around with the data, you want to have a positive attitude towards pre-existing research. So in some sense, everything gets very tilted that we're going to get conclusions that fit what we in some sense want.
Yeah.
So that's sort of that's not you. It's just intrinsic to this kind of the problem in my mind. In other words, you looked at the problem, which is very, very ambitious, and then you put, quote, economic concepts on the table. But when we start to think about how the accounting works, how the real world works, with asset, the asset acquisitions and and you get the goodwill account. You know, the goodwill account is in itself going to be very, very, very prominent in these things. So once you start to have to deal with all of these potential problems, it becomes, from a prior point of view, more difficult to arrive at a robust conclusion.
Yeah.
And I think my point is only, I think that your problem, the way you approach it from a point of view of the pre-existing literature, you make the problem too robust. I'm sorry, too non-robust. In other words, that's why I tend to think about how would I do it. And I would really just try to ask the question, do companies that have heavy investments in intangibles, for example, very high to market to book, or whatever have you, do these kinds of companies, in some sense, capture a trend that this is where the action is of good economics and profitability?
Yeah.
So that's sort of just my take.
Yeah. Yeah, I do feel confident in this. You know, they're very important problems in economics. So I'm sure people are going to continue to revisit them and test the robustness of
Yes, yes, they
existing
are. They
research.
are.
Yeah.
In other words, it really comes down to, this is a sign of age.
Yeah.
What has happened to market to book over the past 50, 60 years? The market to book has sort of endlessly being appreciating, and it cannot be explained by leverage. But so that means that we turn our attention to what about all of the intangibles? Has accounting become more conservative and whatever have you? That's where in my mind, and talk is cheap, that's where the questions really are. In other words, if we look at today's stock market, at least people from my generation were just astounded by the P, by the forward Ps and the market to books.
Yeah.
But the story is, of course, it's in the intangibles.
Yeah. Yeah. We'll have to wait and see if they materialize as future benefits.
Yes, we have to. Okay.
Yeah.
We can keep waiting forever until we
Yeah.
get the correction. Very good. Yeah, very interesting.
Okay. Well, thanks, Jim. Yeah, good to hear you again
Yeah, yeah.
and see your books.
Yeah, the books are better than the head. Don't worry.
Okay. Well,